So let's get right into it and ask our panel some questions here. So we'll start off with, why would someone need a loan mod? Maybe, Loreen, you want to start with that one?
In most cases, the homeowners that we've run across are delinquent and are usually already in foreclosure. They want to try to exhaust every effort to keep their home prior to giving it up, either deed in lieu of foreclosure or losing it by short sale. So, for the most part, that would be the very last avenue that they would have before actually losing the home.
Yep. And then, Journee, we discussed a few other things before the panel here. What were some of the other reasons why people get loan mods?
Imminent default, which is practically if they are, even though they're current, they're facing possible loss of either employment or reduction in workforce in terms of their businesses. That can cause them some financial distress. So they can also apply for loan modification even though they're current. Touching up on her situation too, if they're delinquent, they're in foreclosure, loan modification is a great way to get caught up when they're delinquent. It also assists in making sure that the consumer can actually have an affordable payment as well. Other than that, taking advantage of the possible housing situation where they can actually have a better interest rate and pay less interest.
Yep, so a few of the other ones that I had just written down as my notes here is rate adjustment, like you mentioned, affordability, stress, like Loreen mentioned, financial assistance, bringing current, credit repair, and maybe if they're about to face an adjustment in interest rates.
And credit repair is actually a great thing to do.
Can you elaborate on that?
Practically, they're behind, so definitely it's going to be a negative impact on their credit. With the modification, it brings them current, deferring the past due balances, which in turn, once the modification is complete, moving forward, whatever is their post-mod payment, that will reflect in their credit. And as they continue making payments, let's say moving forward for 2 years, they could possibly qualify to refinance.
So it won't show up as a late payment, and they'd have a good mortgage history and they can refinance.
From when it's fully modified.
So from trial modification to full modification?
No, from the modification completion.
Okay.
Yeah. Unfortunately, with the trial, because the servicers are required to pay, are required to report factual data. On the trial, normally they're not. It's not enough to bring the account for the current payment. So during those 3 months that they're on the trial, they're still going to be reported depending on if the trial payments are enough to cover some of the payments that are due.
And then it goes into a permanent modification status?
Yes.
Okay, and at that point, it's reporting not late.
Correct.
Okay, that's a great thing to know. And why would the bank give a loan mod?
It's a great benefit to them. They want to prevent as many foreclosures as possible. The banks doesn't really make a lot of money foreclosing on properties. Obviously, they have to sell the property in auction through foreclosure. They're losing tons of money. Therefore, they have to write off the losses. Even though technically they bought these loans maybe with a discount rate or a discount per dollar, it's still not a good thing for the banks to do a lot of foreclosure. Plus, it's a negative media situation as well. You don't want to be the top banks being known to just focus on profits and not help out the consumers.
Yep, and Kristian and Loreen, anytime you want to chime in, please don't hesitate to. So maybe Kristian, you can help us with this next question. Who do you think is the ideal candidate for a loan mod?
The ideal candidate, I'd say, is somebody who has fallen behind on their payment for whatever reason. They've come across a hard time. They've got a loss of a job. They've got a health concern. They've got bills that obviously have stacked up that they couldn't pay. And it's a temporary situation, right? It's something that they got into, which, given the opportunity, they could get out of. But unfortunately, due to the 3 months, 4 months, 5 months of back payments, now they're forced with the situation of I've got $18,000, $20,000 in delinquent payments that I need to come up with, and I just don't have the means in order to do that. So a perfect loan modification candidate is one that has the ability to pay on an ongoing basis, but for whatever reason has fallen behind. They can go back and they can say, okay, I can make my $2,500 a month payment going forward, but how do I get rid of these arrears? How do I get myself back on track? Those types of people we find are just, they need that little extra help in order to be able to get themselves back on the right track. And those are the people that we love to help in the real estate industry, because once we've helped them and we've got their life back in order and they're back to a current status and they're making their payments, and we've been able to see them through that process, we've got a fan for life, right? We've got a customer for life, and that's what a loan servicer wants too, right? If you're Bank of America or Wells Fargo or Chase, you want somebody that said, hey, when I came on hard times, the people at Chase really, they lowered my payment for me. They forgave my arrears. They helped me in every situation possible so that I could get back to what I needed to do, and therefore I'm going to be a Chase customer for life, right? And that's a great customer to have. So I think as you were speaking to the ability for the loan servicing company or the mortgage company to be able to present themselves in a good light, especially the general public, and say we were able to help 12,000 people last month, get back into a current status on their loan where before they were behind and they were a notice of default or a foreclosure candidate. So that's going to be the perfect, I think, example of somebody who can be helped with a loan modification.
Okay, great. So leads right into the next one. How is it determined whether someone qualifies for a loan mod? And maybe Loreen, you can start with this one and we'll have Journee wrap it up.
Depends on the type of loan mod. If it's under the federal program, there's several different programs, I guess. HAMP, HARP, there's different tiers for a first mortgage, a second mortgage. The federal program, your gross income needs to be 31% over your principal, interest, insurance, and tax payment. If it's a traditional loan that's not under VA, FHA, or whatever, they calculate it a different way, taking your household expenses versus your gross income. So one thing that's really important is to determine what type of loan you have and make sure they're calculating it correctly in order to determine that qualification. Otherwise, a lot of people can be disqualified because they use the wrong calculation for that particular loan.
So just to add up more into that too, just knowing the investor requirements, maybe looking to finding out the loan rate for each particular investor is a great way, because you can also figure out if there's something that you can maybe negotiate or discuss with the servicer who is offering these different programs or different rates or different terms. So with knowing what the floor rate will be, you're able to go ahead and call the servicer, make sure that everything is calculated properly, and make sure that they can actually fit into the best possible term for the clients or the customers.
I think that's very important to know, and a lot of people don't understand that there's two parties involved with any loan, right? You've got the servicer and you've got the investor, and most people don't know that. They say I make my payment to Bank of America, one that owns my loan. But that might not be the case, right? It might be owned by U.S. Bank. It might be owned by a completely different investment company altogether, but Bank of America is servicing that loan, and vice versa. I mean, Chase could own could be servicing a Bank of America loan. So when you have those two different parties that are associated with any loan, when we're calling on behalf of the client, we're usually giving them a loan number, and we might be calling Ocwen, who's doing the loan servicing, but the owner of that loan is U.S. Bank. Right. So they have to get approval from U.S. Bank whenever they decide to make a loan modification or what they're going to do in order to help that client out. But having that determination of knowing, okay, we're not just dealing with one party, right? We're just not calling the loan servicer and getting an okay. Some loan servicers do have the power of authority to make those determinations, right. But a lot of them have to defer to the investor and say, hey, are we able to modify this loan for this customer? And if so, what can we offer them?
That's true. Okay. So we'll start with Loreen on this one. What's the most effective way to work with the bank to get a loan mod?
To submit a full application package the first time. The banks have a tendency to lose parts of the package, so you really got to keep your records. You got to stay in contact with them. You got to follow up with them. Don't expect them to follow up with you. Make sure you have all your tax returns, your pay stubs, your expense reports, anything along the line that's usually required documentation. It's pretty standard across the board for almost any lender. So getting that documentation together and submitting a full package immediately is number one criteria.
Journee, did you bring a sheet that says that what you need to bring, or off the top of your head?
Just top of my head, just really hardship letter, right? Make sure it's signed and dated. Make sure most of your documents are always up to date. For my company, normally it expires every 90 days. So it's always good to have updated documents and be ready to go ahead and send it. On top of her tips as well is to make sure you understand the income situation of the customers. Because from there, if you know your income situation, if you're a wage earner, you're more than likely going to need a full month's worth of pay stubs. Now, depending on your pay frequency, if you're, let's say, a monthly type of wage earner, you're going to have to provide at least 2 supporting documents, consecutive pay stubs. Also, on top of that, depending on the investors or depending on the type of modification program, you also need to learn the application. So let's say for a home affordable modification, you need the long form request for mortgage assistance. There's a certain version type that actually you need to be aware of. Make sure it's the most recent type. If it's a standard modification, maybe it's a private investor loss mitigation application form. If it's a Freddie or Fannie modification, you're going to require to send the borrower response package. Usually I think it's like 4 pages. 45060, 45060 versus 45060 EZ. You just want to use 45060. It's acceptable across the board. If you use the 45060 EZ and it's not based on...
Clarify that that's a tax form, it's an IRS 45.
Oh yes, thank you. Going over.
That allows the lender or the servicer to access 2 years of your tax returns
You get your tax.
if you can't provide the tax returns yourself.
Yes.
So
That's good.
No, that's good. That's excellent. And the thing with that too, with the 45060, is it has to be pristine, it has to be perfect. Because a little slight alteration, a little slight mark, the servicer is actually going to deny it. And it's not really the servicer, it's the IRS that's very, very strict. So it's them that actually will tell the servicer, I cannot accept this document when you're trying to process this 45060. Bank statements, FHA right now requires at least 1 recent complete bank statements. Bank statements is important, especially for rental income, Social Security, pension, retirement. If you're self-employed, 3 months consecutive bank statements, and just make sure it's a complete, complete pages. So even if the last page is the advertisement or intention to be blank, you got to send all pages.
One question I would have on that is we get a lot of times where there's a couple, right, that are on a loan. So there's a co-borrower, and for whatever reason, those people are not on speaking terms anymore.
Oh man.
And is it possible to get a loan modification if you've got a husband and wife, or you've got 2 people that have originally filled out the loan documents, and now one of them's not cooperating?
So it depends. If there's a finalized divorce, then you obviously need to ask for the finalized divorce decree, because the servicer needs to find out which property is awarded to. Like, is it awarded to the wife or to the husband, regardless where it is. But at the same time, they're going to ask for the recorded quitclaim deed. If, let's say, there is no divorce, they're just separated, you can go ahead and request for a non-contributing documentation that the ex-husband or soon-to-be ex-husband is no longer contributing to the property and I no longer live in the property. But if, let's say, there is nothing that's concrete about if they're separated, then the servicer may still request for the financial situation on the spouse that's not living in the property. So rental incomes, do they own another property? They're going to ask for mortgage statements and so forth. Just understand that servicers can also do a soft pull on their credit. So if they see outstanding loans on there or maybe additional properties, they will question and ask for mortgage statements.
Okay, great. So how much could a loan mod improve a payment? Just roughly, is there a specific number, or is there times where it's
There's
more
no
or less?
specific number, but at least the requirement is at least 10% reduction. So if there isn't 10% reduction on the payment, they're not going to be able to approve the modification. That's usually a requirement by Freddie. It's just to let them know that, why are we even going to modify this if it's not enough to even provide substantial savings to the customers. What I've seen before, depending on where the rate was originally at, I've seen it from 12% going down to 4% or 6%. That's a good savings depending on that payment. or depending on the balance, between $600 to $700.
We should point out too that many times, particularly if they're taking the principal balance and rolling it over to the back end of the loan, the modified payment could actually be higher than the regular loan payment. So
Yeah.
that surprises a lot of people, but it happens more often
Right.
than you would
I
like.
agree, Loreen, and what we've seen in the past is when what used to be a really great option for people was the option arm payment, right? Which allowed them to pay the actual minimum,
Right.
which was a negative amortization loan, right? So all of the payment that you weren't making towards the principal and interest got tacked on to the actual loan balance.
Yes.
And that was a huge loan to get back in 2005, 2006, 2007. And now, if you wanted to try to get a loan modification on a negative amortization loan, you're going to have to start paying principal.
Yes.
So that $1,500 a month payment turns into a $2,500 a month payment when you're doing an actual loan modification, but it's paying down your principal. So a lot of those option ARM payments that were so popular are unable to be modified.
But it's tricky too, because sometimes if the consumer has never paid or hasn't paid their taxes and insurance, there might be a reduction on the principal interest payment, but the payment still increases because of having to catch up these past delinquent taxes and insurance, and upcoming insurance and taxes. So there will be situations where maybe they're at 3%, then they got modified, and now they're at 4%. That also can happen. So it really depends on every cases on the customers. So yes, it could be a benefit only in terms of bringing it current, but it also could be a negative impact because now it's raising the payment.
Okay, great. So why do loan mods get denied? And what do homeowners do at that point?
A lot from my company is incomplete packages. Just simply that, either the customer just throw their hands up, they're done. They've been dealing with the prior servicer. They're tired of sending the same documents, and they're not getting the explanation. Otherwise, too, if they're not explaining their situation thoroughly, the underwriter can look at it as like, look, it's not enough to deem as they're having a financial hardship here. If they're already at a low rate, if their rate is already at 2%, for example, and we're trying to review for a modification, underwriting for a modification, there's not enough reduction that we can actually do, they can get denied for that modification.
Oftentimes as well, the homeowner has insufficient income. Quite frequently we run across homeowners that have no steady income, no steady sense of employment,
That's true.
and they still want to try for that loan modification. We work with them, we do it, but they're most likely going to be denied.
Yeah, I agree. A lot of times people don't understand that when they do fill out that 4506T, that the loan servicer is going to look at their last 2 years of IRS tax returns, right? And if they show no income, even if they do have income right now, it's going to be questionable. Or if they show a really small amount of income, if they're self-employed or if they're 1099 or however that works, they're not going to have the income in order to qualify for an actual loan modification because they can't afford that payment, whatever it may be.
Right.
So that's a hard question for a homeowner: is why can't I get a loan modification? And then you say, well, do you show the income in order for the loan servicer to be able to process this modification and make it final? And it's a lot of times that they've been working and they do have a job, but they can't document that income,
Right.
or it doesn't show up on their tax returns.
And a lot of times, sometimes too, like the separation where the spouse is just not willing to cooperate and sign documents, and it can only, the servicer can only hold on to that file or that possible modification offer for so long. And maybe a month and a half pass, they're gonna have to make a decision. Do I want to continue holding on to this, or are we gonna go ahead and deny it? And more than likely, it will be denied.
So one of the interesting pieces of this chart that we found recently, and this is through April of 2015, is that the denial rate has actually been going down, which is great. So when loan mods have been going on for several years now, and they peaked at almost 83% denial back in 2012. So most loan mods were getting denied. And now as you look down, it's been decreasing, and now it's just a little over 60% in 2015. I think that number's gone down now. And partly it's because people are getting better informed and having a better idea of what would qualify and maybe also getting set the right expectations, right? So that's promising for people that do still want loan mods. But another key thing that we've been hearing is that these HAMP loan mod program might be ending at the end of the year. You guys familiar with that?
Yes.
So what does that mean for customers?
Pretty much by as soon as January hits of next year, no servicer is going to be accepting HAMP modifications anymore. If they're informed, if they're aware, I suggest they apply for a HAMP modification now.
As long as the notification package is in process as of December 30th,
Yeah.
it will still be processed, but
Yes.
they're not accepting new ones. But that's just for the federal program. Certain lenders and servicers do offer our programs in-house.
Typically for my companies, normally we'll review for HAMP modification. And if we deny for a HAMP modification, we automatically will try to underwrite them for in-house modification.
Is there a benefit to the bank to do a HAMP modification? Do you get paid by the government or something to,
Yeah, they're incentivized as well.
there's an incentive to the bank?
And it's a great incentive for the consumer. And it's for my personal experience with my condo, actually that I recently sold, I had HAMP modification. And what that does to me is it brought down my rate from 7% fixed down to 2% for 5 years in a step rate and so forth. At the same time, as long as you continue to make your payments on time, the government will actually send additional money to go ahead and pay down your principal balance. At the same time, I think that's the same incentive that the servicer will get as well.
Okay, so we kind of covered over some of these questions, so I'm going to skip through them in terms of percentage of loan mods approved. How many are successful long-term? That's a more ambiguous question because it's hard to track that. You guys have any sense of how many loan mods are a good permanent or long-term solution for a homeowner?
As an overall, I'm not too sure.
It's hard.
We see a lot of homeowners declaring Chapter 13 bankruptcy so they can restructure their debt. And when we do see that happen, it's a 3 to 5 year process to restructure that Chapter 13 bankruptcy. And then what we do see in the bankruptcy courts every week is 3, 4, 5 relief of stay motions are filed by lenders on that Chapter 13 bankruptcy debtor in order to take that property out of the bankruptcy and then be able to start the foreclosure process. So I don't know what the total numbers look like, but we do know just filing a Chapter 13 bankruptcy or getting into a loan modification or whatever they're doing, maybe just forestalling that process and kind of kicking the can down the road a little bit rather than solving their problem. It's just giving them a little bit of additional time. So the loan modifications, I'm not sure what the long-term success would be. And also, too, I think that one of the hard things is to figure out, are they underwater, right? Is the home still significantly undervalued compared to their loan? So if I owe $800,000 on my home and it's only worth $600,000, I'm not really incentivized to continue to make that payment. Whereas if it's all of a sudden I owe $600 and now it's worth $800, sure, that loan mod's going to be successful because I can sell my home, move out of it, and not have any problems going forward.
Actually, I do have some statistics. I should point out that there was no reporting requirements for any of the banks or services until 2009. So 2005, 6, 7, 8 is up in the air. And in 2009, they realized that we need to figure out what's going on. So moving forward from 2009 to now, of the people in trial modification, 23% fall out and fail to meet that trial modification period.
And that's the first 3 months?
The first 3 months. And for those who make it past the trial modification, 27% fall out of the modification. So overall, that ends up being half the modifications into trial and going forward, the people can't complete.
Okay. So let me ask you this. I've got a foreclosure date coming up real soon. What are my options? What can I do?
Depends on the state.
Okay, so we're in California. What do you think?
California, you have a homeowner's bill of rights. You have 24 hours to submit a full package. It has to be deemed as a full package by the servicer in order for them to put the foreclosure on hold and proceed with the modification review. If it's a treasury HAMP, you have 7 business days to have a complete package. Depending on how soon the foreclosure is, if the foreclosure is about 38 days, calendar days from the sale date, then you have a chance of putting the foreclosure on hold, therefore avoiding the dual tracking by the servicer. But if it's within 37 days, more than likely they will accept your modification. They're just going to review it, rush review it, but they're not obligated to put the foreclosure hold. Nevada, I think is 24 hours. Minnesota is 7 days. I think New York and Washington is about 15 days. So each state has its own requirement. But I know for California it's 24 hours.
Okay, so the same in California. What if they decide, okay, yeah, you're right, I don't want this foreclosure, I want to short sell it? Can I send an application a day or a week before for a short sale?
To be quite honest with you, I'm not too sure.
Okay.
Different lenders have different requirements. If it's 15 days, within 15 days of the foreclosure date, some lenders won't accept application packages for alternatives. They'll proceed with the foreclosure.
We've been told by a lot of the larger institutional lenders like Wells Fargo, Bank of America, Chase, that if they don't have that 10 days prior to that trustee sale going through, they're not going to look at anything really. They're not going to start another process. So it does depend on, it's a lender-to-lender type of basis, but they're being realistic, I think, in most terms, because if I'm submitting a loan modification or a short sale or deed in lieu, and it's a week before or a couple of days before that trustee sale date, it's too long.
Right.
You've waited too long. You've had that 90-day notice of default period. You've had that 21-day notice of trustee sale period. So you've had about 4 months to solve this, and now you're waiting until that 0 hour to try to get everything in and try to solve that problem. And they're not buying it. And so we usually look at it and we try to tell the homeowner, hey, you've come to the end of the rope. We can help you up to a certain point, but once you've hit that 10 days before a foreclosure trustee sale date, you're pretty much out of luck.
Right.
We're lucky if we get 10 days sometimes. Usually it's 2 days before the foreclosure that they come to us for help.
Yeah. In that case, that bankruptcy may be their only option. So you can file an emergency bankruptcy, and that'll at least postpone that. That'll put a stay on all of your assets until the bankruptcy court has heard the filing. And that may be the only alternative to get that person a little bit of extra time. And many people don't want to file bankruptcy, but that may be their only option.
Unless you have the funds to reinstate the loan.
Right.
Or come up with a down payment for a repayment plan. So those are the only two options as well, on top of filing bankruptcy.
Okay. So next question, how long does it take to get a loan mod? If I send in a full package, how long could it take?
Underwriting takes, we have to allow the underwriter 30 days to make a decision. But the underwriter can also request for additional documents. As long as the figures are already calculated, you have all the figures that you need from the escrow department, you can actually make a decision within a day or two, just depending how quickly you can get it and how much of a pipeline you have. So, but you got to understand, with these big banks and these companies, they have thousands of customers applying for loan modification. So the ideal situation is about 2 to 3 weeks.
Okay. And say I get denied, is it possible to reapply and keep sending it in?
It depends. If you really have a significant financial change from the last time you applied for a modification, yeah, you have a shot. But if they realize that there's really no income change, they're going to automatically just deny as soon as they see your application.
There is an appeal period,
Yes.
23 days. But as you said, you can file the appeal, but unless you can show some kind of substantial mistake with how they calculated something, it's just going to be an automatic denial.
The appeal, it also, it's not for every single mod decision. If the sale date is just too soon, I think it's like maybe 60 days or 45 days, the servicer will not allow you the appeal process. And then with the appeal, you have 14 days to submit your appeal for them to go to consider and review your appeal.
Okay, great. So the other idea is, if we get a loan mod approved, Kristian, maybe this one's for you, how could a bankruptcy help if you couldn't get that loan mod?
Bankruptcies, Chapter 13s, they do have the ability to strip out a second. So if your home is significantly underwater where that second has no equity whatsoever, so say you owe $500 on your first and $100 on your second, and your home's only worth $450, if you can show to the bankruptcy court, my home is only worth $450,000, and I'm going to create a payment plan that's going to allow me to pay off all of my back payments and everything over the next 3 to 5 years, at the end of that payment plan, that second will be completely wiped off.
That's awesome.
So that's the one reason I would think where you might look for a loan modification, or you might still look at a bankruptcy as an option. If your home is significantly underwater, and that second loan is going to be completely wiped out anyway, and if that first was to foreclose, they would still lose their entire position. But that would be one reason. Also, on the loan modification side, bankruptcy may just buy you that extra time, right? It might get you in front of the lender's eyes to say, and we see this in the bankruptcy courts, where a person will apply for a loan modification while they're in bankruptcy, showing, okay, I can make these payments, but I can only make them to a certain extent. And it's kind of like forcing the loan servicer's hand and saying, all right, will you take this? And then it's really a judicial decision at that point. It's the bankruptcy court that's listening to both sides of the story and saying, yes, you should side with the debtor on this one, or no, the loan servicer has the right to foreclose and collect on their collateral.
Okay, great. So I've heard conflicting reports about bankruptcies, and a lot of homeowners are scared of it. It sounds like a scary name, but I've heard people say that, yeah, bankruptcy is saying, hey, you had bad debt and now you're taking care of it and you're going to be a better credit risk in the future because you've now wiped out some of that stuff. Other people saying, no, it's going to make you a pariah and you won't get credit in the future. What's your take on the outcome of getting credit, having a bankruptcy, and how that affects your credit and your credit worthiness?
Well, one of the things that everybody looks at is their credit score, right? So what's my credit score right now? If you're 90 days behind on your mortgage payment and probably all your other bills, your credit's going to be in the 400s, right, or the 500s. A bankruptcy that would eliminate all of those bills, all that unsecured credit. So if you've got $30,000 or $40,000 or $50,000 in credit card debt or unsecured, loans that are out there, that's completely wiped off. Your secured debt is still going to be there, and that's going to always be something that goes along with the bankruptcy. But a lot of times your credit score will go up drastically after a bankruptcy. After the bankruptcy discharge, you can see a 100, 200 point swing, because not only did you remove all that debt, you can't file another Chapter 7 bankruptcy then for another 8 years, is my understanding, based on the law. So you really have got yourself in a situation where, okay, if a creditor does give you the ability to borrow, they know that they can go after you for the next 8 years if you fail to pay. It does. I mean, it's not. It's obviously got a stigma to it where, okay, you declared bankruptcy, you couldn't make your payments, but at the same time, in terms of if you're drowning in debt, it may be your only option, and it gives you that ability to get back on your feet and to clear the slate and say, okay, I made mistakes in the past, and going forward, I hopefully learned from those, and I'm going to be able to be a better borrower going forward. And I do see that, like, most times for a mortgage loan, it's 2 years. Typically, if you can show a good credit history for the 2 years after you declare bankruptcy, you can go and get a underwritten, Fannie Freddie loan. Whereas a foreclosure is going to be on your record for the next 10 years, and you're going to have a hard time convincing a lender to say, okay, give me a second chance, give me another mortgage, because I didn't take all of the mitigation options that were out there for me. I didn't do the loan modification. I didn't do the short sale. I didn't do the deed in lieu. I sat there for as long as I possibly could, not making payments, and now give me a second chance. So that's a hard thing to explain to a mortgage lender, and it's going to take a longer time period to prove your creditworthiness in order for them to get you back onto that, mortgage, being able to qualify and be approved for a new mortgage.
Okay, great answer. And this chart that I've got here kind of sums up what Loreen mentioned earlier, is that the delinquency rate for a modified loan within X amount of time based on how late they were. And it roughly gives the details saying that, yeah, about half of the people, it turns out that a loan mod may not be a long-term solution for them. And it didn't even turn out to be a short-term, it just kind of kicked the bucket down the road, as we discussed. Okay, so we got some more bonus questions. So a lot of clients of ours and customers and people that we've met have gotten a lot of help from Keep Your Home California. Can any of you guys explain a little bit what Keep Your Home California offers to homeowners?
It's basically an overall package of the federal programs, but they have additional unemployment programs.
Yeah, so so what they do is they can actually offer to either fully reinstate, or they can reinstate and help you through unemployment assistance, which is making your mortgage payment once they cure the delinquency. Principal reduction recast, principal reduction modifications, Also, if you're, I think it's relocation assistance. In the event that you did a short sale and you need some relocation assistance, I believe it's like $2,500. They'll go ahead and provide you $2,500 to pack everything and do whatever you need to do.
It's up to 5,000.
Is it
In some,
yeah?
but most places only do 2,500, 3,000.
Right.
They also do a grant of funds, where they'll actually give you a certain amount of funds, and you do not have to pay it back after a certain amount of time, provided that you don't go into default again in your home and other qualification requirements.
And the thing with this is if you do accept and write up a promissory note for it, there is a lien for it. It stays there for 5 years, but like she says, as long as you are staying on track, staying in your home, did it not sell it within 5 years, you're not obligated to pay that back. They actually will write that off.
Wow. Yeah, so some great programs that the state's offering through a federal program.
Mm-hmm.
Okay, great. So a couple more bonus questions. Say you approve a loan mod for me. Could I negotiate those terms and ask for something better?
Yes and no. I mean, at least for my company, no, because you have to provide supporting calculations. We actually miscalculated your income. If that's the case, then I'm sure they're going to re-underwrite it, be able to offer you a better term. But if everything is right, you're not going to be able to negotiate that. Okay. What you can negotiate though is good faith payment. Sometimes you haven't paid maybe 2 years, 6 months, and then they're requiring maybe 1 to 2 months worth of payments. You can negotiate and say, look, I can't afford a good faith payment. Add medical bills that just came up. So sometimes what they'll do is they'll waive it off, or they'll put you in a trial payment, make it for 3 months, and then they'll go in and give you a permanent modification.
Okay, excellent. So here's a couple more bonus questions. I didn't do the modification. I didn't do the short sale. I didn't figure out any loss in it, and my house got foreclosed. But I had equity. Can I get some of that back? When? How? How does that work?
As far as I know from what I heard, I've never really seen it personally. If there is an equity, in equity decision, we had to cut that check to the person that lost their home.
So to answer your question, Henish, is typically in a foreclosure situation, somebody may have equity. They may only owe $200,000 on a $400,000 house. But depending on the other lien holders and depending on how much in arrears they are, that $200,000 loan may have ballooned to $300,000, $400,000 or more, right? So the back payments, the attorney's fees, all of the other portions that the escrow payments, that the insurance payments, the taxes that the lender's making on your behalf are all going into the balance of that loan. So even if they did have, quote, equity in their home, it's gone usually when the trustee sale happens. Because if somebody does bid on that, that property in trustee sale, typically they're not going to pay market value, right? So if it's worth $400,000, an investor may buy that at the courthouse steps for $300,000. So all of a sudden that $100,000 in equity is gone. If they did overbid and the loan balance plus arrears plus everything was only $250,000 and they bid $300,000, that additional $50,000 would be a check paid to that homeowner based on the fact that they did overbid the mortgage.
Only if there are any other creditors on the property.
Right. If there are other creditors, there's the IRS, if there's the state of California, if there's any other credit card that's put a lien on you, then all that money is going to go directly to them. So that's always an issue as well, is that people who do get foreclosed on, who do have equity, there's always other paths that they can take. I mean, a short sale would be the easiest one, even if they're close on that. But foreclosures, and we see it all the time, Henish, in our business, is when we meet with somebody who's in distress and they say, oh, I've got an attorney who's working on this, or oh, my loan modification is in the final stages of underwriting, and all of a sudden their trustee sale date happens and it gets foreclosed on, and your next call you're getting from them is there anything I can do? And the answer is no. I mean, I'm sorry. We gave you your options. We tried to help, but once that trustee sale date comes and goes, there's nothing we can do.
So you brought up a good point, and there's a lot of companies that are still out there saying, hey, we'll get you a loan mod, but you have to pay us $3,000 or $5,000 up front. What would you say to a customer about that? Is that a good idea, a bad idea?
It's illegal. People applying for loan modifications cannot be charged anything from counselors to attorneys until after the modification is fully approved. So during the application process, if they are asked to pay anything, it is completely illegal in the state of California. In fact, since they started recording the modifications, the sanctions against attorneys has gone up 60% for attorneys running modification scams. So whereas you think you can go to someone for help, you got to be really, really careful about the attorney too.
Okay, so last question. So, you've got a homeowner that's facing distress or is about to get distressed. What advice would you give a homeowner? We'll go down the panel here.
The biggest thing I can say is you start with the loan modification, right? That's where we always like to start with homeowners is if they qualify for a loan modification, get them a loan modification. They're the happiest person in the world when they've received a loan modification. They're going to rave to all of their friends and their family on how Kristian helped them get their payment reduced or get back on their feet or get their credit back in order. So that loan modification should always be the first option, and we can perform those for them and help them do that and make it as easy as possible, right? We want to be able to give Journee all the paperwork so that he underwrites it, gets it approved, and 30 days later, you're back in in the game. The second thing is a short sale, right? You can put your home on the market, see what offers you get, and present them to the servicer and say, hey, I got an offer for $400,000. I know I owe $500,000, but will you take it? And typically the servicer is going to say, okay, right? As long as it's a fair market value. And they usually say, and we're going to pay you, right? Relocation assistance. It might be $1,000, it might be $10,000, but they are going to give you something to cooperate and to create that process so that they don't have to go through the default, they don't have to go through the foreclosure, they don't have to pay the attorney's fees. So short sales are great, and they're great for the homeowner too because it gives you a time frame, it gives you the ability to move out, it gives you the ability to get some money, and it gives you the ability to move into something for the next couple of years and show, okay, to a rental potential, I did take care of myself. I did do what I needed to do. And 2 years later, you're qualified for a mortgage again. So short sale would be the second thing. Deed in lieu, that would be my third choice. Deed in lieu of foreclosure. Instead of me waiting until the foreclosure, I can sign a grant deed or a quick claim deed directly to the loan servicer and say, all right, I'm giving you my keys. I'm done with the property. Many loan servicers will give you a cash incentive to do that as well. So I've seen people from, a lot of the large institutional lenders get $5,000 to just sign over a deed and give them the keys. Great. Third option. The fourth option, is bankruptcy, and that may be a way to restructure your debt, get back into things. And the fifth one, if you don't do anything, you're going to get foreclosed on, and it's going to happen at some point. And anybody who tells you that no, you can put this off forever is just not telling you the truth. But those are the 5 main options that I'd see in my point, and I'll let you guys answer as well.
I totally agree with him. It's modification should be your first step. I mean, obviously, if you have the money to go ahead and bring it current and get on a payment plan, if your rate is already great, then do that. If you don't have it, modification is a great way. Short sale too, because for normally what they'll do is they'll incentivize you, give you financial incentive if you want to pursue and cooperate through a short sale. At the same time, I believe that if there's whatever is the difference, is you're not going to be taxed for it as shown as an income. So that's a great incentive. Also, it's a great way to improve your credit, even though you're about to face foreclosure and you got through a short sale, so that new creditors will see that you were responsible, take all the initiatives to be able to be to do something about your house rather than allowing the foreclosure to just take place. Deed in lieu is a great option as well if you're not so close to the sale date. And again, that's just another way of showing the new lender that's reviewing your credit that you're taking responsibility of your investment.
And just to focus on maybe a different angle for real estate agents who are working with these homeowners who want loan modifications, while you may walk away nothing out of it other than a sense of goodwill and good karma, the loan modification package is very, very, very similar to the short sale package. It's not the same. If you know how to do a short sale package, you know how to do a loan modification package. And to offer that homeowner that first step of saving their home, even if you know it's probably not going to work, it really does make a difference to these people. And then when you move forward to the next level, it gives them a little time to focus and come to the realization that they're going to have to work on a short sale, a deed in lieu, or be foreclosed on. So it's really a good way to build a relationship with these distressed homeowners.
Well, great. Well, that's our time. I appreciate everyone for listening to us, and I appreciate the panelists for sharing all your information that you've acquired over years of experience. And thank you so much for spending your evening with us.
Thank you.
Good night.